Hello, this is Dee. Welcome to daytraders.com. Today we discuss from our trading journal trade number 28, the put credit spread we put on Apple. Yes, this is the Apple Incorporated shares that you're thinking about, that you know about. Apple that's trading almost at a daily volume of 27 point something million shares a day just for the stock, and the options on Apple are very highly traded as well. In the options world, this is one of the most traded option underlyings in the options world, and they have in fact options expiring on a weekly basis, unlike other options who only issue monthly expiry options. So on March 17, 2017, Apple was trading at 141, and we basically sold at this date a put credit spread. So we did this by selling the 133 put option, one contract of 133 put option on Apple, expiring on April 28, and bought as a hedge, in short, to cover your ass or our asses if the stock price goes beyond this price, 131. We bought this option as a hedge. This option was also expiring on April 28, 2017. That's in 42.28 days at the time of the trade at March 17. And we received for this a credit of $25. So net of transaction fees of 2.19, that's your net credit. And your net credit is important because as an option seller, this will be your max profit. So your max profit is 12.87 of your max loss. Now what's the max loss? This is the max risk. And the max risk or the max loss that you can suffer, or we can suffer, in case the trade goes wrong, in case our strike gets hit, we weren't able to roll over, we weren't able to do anything at all anymore, is at a very, 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 very unfortunate event, it will be 177.19. This is the result of the difference of the two strikes. That's 133 minus 131. For example, here, the difference of the strikes times the multiplier of the options that you bought or you sold, multiplied by the number of contracts or combos that you bought or sold. Yeah. So that's basically one contract. Let me just highlight this. One contract times 133 minus 131. That's 1 times 2 times the normal equity option multiplier of 100. This just simply means that a contract is equivalent to 100 shares of Apple. That's what you control, or what you sold insurance for. So where was I? The max risk is 200. That's the difference of the strikes again, times 1 times the multiplier, minus the net credit you receive. And that's going to result to 177.19 US dollars. And this net credit is important, that you have a good ROI ratio and that you don't accept poor ROI simply because you don't want to be selling as an insurance seller, for example, for a less price than you should be accepting to cover your ass if in case some of your trades go wrong. which can be statistically followed. When you execute the trade, it's often provided in the broker platform. Alright, so we bought this back after 12.19 days for a closing price of, for a buyback price of 12. Plus we had to pay 2.19, that's a total of 40.19. This reduces our net profit to 8.62 USD, and 8.62 USD simply is the credit that you receive minus all the brokerage fees or commission fees to the broker, paid to the broker, and minus the buyback price, of course, to close out the option. Well, you could wait this trade out after 42 days and earn the whole max profit or the whole net premium of 22.81 cents, but this was just a sweeter deal for us to close after 12.19 days, since you avoid the waiting time of 30 days more just to earn the other half of the cake. So let's take a look at our chart and follow our trade. Basically, this was when we sold our put combo, and the arrow is a little off, but this is basically when we opened our trade. Here was a volatility crash, and the volatility of the options since the opening of our trade, if you would retrace it, went up though. So this didn't help our position, and volatility going up doesn't really help our position, since higher IV environments, in higher IV environments, option prices or option combos tend to be more expensive. This doesn't do us good as option sellers, because this just means generally we would be buying the options combo at a higher price, assuming everything stayed the same. What helped us though is the price movement from the start of when we sold the combo to the time that we closed it. It went up, so like $2. This might have been on other directional accounts as a directional trader much, especially when you misuse leverage, but more to that on another video. I will discuss that thoroughly on why directional traders lose more, and some even blow their accounts just because they don't know what they're doing or how they misuse leverage. And this is the candle that, the arrow that I prepared. This just gives you a visualization of the expiry date of the combo that we sold. And basically it would expire out of the money, but since we could take it out after 12 days at a decent profit, we did take it out. So delta, the price worked with us, the IV worked not so much in our favor, in fact not to our favor at all, and of course as net sellers we earn on theta. That means we earn on holding the option combo, and as long as we have the trade open, the combo that we sold earns us money through time decay. So this is D, wishing you happy trading, and keep in touch. Don't forget to share and subscribe. Hope you liked the video. See you again.